So passive investing, well, what is passive investing? Well, at root, it is a pure bet on efficient markets. So the question in the polling was, what is the percentage that the CPP of their equity sleeve of their portfolio, what percentage is held in Canadian public equities, just in the context of efficient markets? Well, it turns out that the CPP holds about 5% of their portfolio in Canadian publicly, this is just the equity sleeve, so 5% of the equity sleeve in public Canadian equities. And it turns out that's actually pretty close to what Canadian equities represent in terms of global market capitalization. So the CPP is pretty close to expressing the bet of all global investors on the benefits, the relative benefits of Canadian equities relative to other global equity markets. In contrast, a recent study from Vanguard shows that Canadian individual investors have 59% of their equity portfolio invested in Canadian equities. So it begs the question, what do Canadian private investors know that our most highly respected global institutions don't? Now you can see the CPP is not alone in its allocation to Canadian equities that is more broadly consistent with Canadian equities proportion of global market cap. You see OTPP teachers with 1.6%, the CAS with 9%. And so obviously Canadian investors are taking a very active stance. They're saying implicitly that they have much greater faith in the ability of Canadian public equities to deliver strong risk-adjusted returns over the next 5 or 10 years relative to the opportunities that are available outside our borders. And so this is, you know, what I want you to think about is if all of these private individuals were actually investing their Canadian equity sleeve in passive index products. So for example, passive index, Canadian index ETF, are they actually passive investors, or are they actually taking a very large, concentrated, active bet on Canadian markets themselves? And that's really what we're going to focus in on here today. If investors in Canada believe that markets are truly efficient, then their allocation would be much closer to the average allocation that we see across all global investors, which is the market cap percentage at 3.3%. So if investors truly want to be passive, then they are believers in efficient markets. And what this means is that they believe that markets at all times trade at or near equilibrium, that the markets reflect the actions of perfectly rational and well-informed agents all the time. In other words, nobody's investing on emotion. Everybody has very, very nearly perfect information. They also believe that market prices always reflect the relative value that the average global investor places on every global asset. They believe that while individual investors on their own may make some pretty grave errors, on average those errors all balance out, and so that the average view of all these investors is generally correct. Now this is a form of crowdsourcing information, right? Obviously we're taking the views of the average investor, and we know that when we're crowdsourcing information, the largest crowd is the best, so we want to source information from the broadest group of global investors that's available, which is just really all global investors. And we always try to illustrate this point using the jelly bean in a jar experiment. Many of you have probably been to a wedding or a presentation or a seminar where there's been a jar of jelly beans, and everybody needs to guess the number of jelly beans in the jar. And what we find is that if you look at any individual person's guess, well, oftentimes it's very far away from the true value, the number of jelly beans in the jar. But if in fact you take the average of all of the guesses, that gets us very close to the actual number of jelly beans. So just a microcosm of what this passive investing paradigm truly is expressing, right? This idea of truly efficient markets, the crowd is always right, and we should listen to the average bets of the crowd. So if we want to express a passive view, we want to express a belief in efficient markets, then we must invest in a way that expresses the following character. Well, we must invest with macro consistency. In other words, it must be possible for all other investors to hold the same portfolio that we're holding at the same time. Now, it turns out that there's only one global portfolio where that is true, and that is the portfolio that has all global assets held in their market cap weights. Of course, we've got to hold all securities in a market. You can't be selective and only hold some. It implies that there's no trading. Now, that doesn't mean that the portfolio weights across the different assets won't change through time, but they will change through time as the value of those assets increase and decrease. It'll drift naturally with market prices, and that will be net of any new shares that are issued or retired, or debt that's issued or retired. Most fundamentally, though, a passive portfolio implies no active views. You're not making any forecasts about the future. Instead, you're just taking the average forecast as implied by the average of a holding of all investors in their market cap weights. So let's explore a passive equity basket as a microcosm of a global market portfolio. Specifically, let's look at the S&P 500. Well, the S&P 500 is actually not macro consistent because it cannot be held by all investors at once, even all investors in US equities. And that's because it doesn't actually represent the entirety of the US equity market. In fact, the S&P 500 is only 75% of total US equity market capitalization. In addition, the sector exposures of the S&P 500 are not perfectly aligned with the actual market cap exposures of the total US equity market, right? We do see some under and over exposures. Now, these percentage values are not percentage points, they're actually just a percentage deviation. So you can see that in the S&P 500, financials are actually slightly underweighted relative to US broad equities. Technology is slightly overweighted. Consumer staples and energy are slightly overweighted. Basic materials are slightly underweighted in the S&P 500 relative to total US equity market. So there are some small sector bets, but they are, they're small. So from a sector standpoint, the S&P 500 is broadly representative of broad total US equity markets. But what about the S&P 500 or even US stocks as a proportion of all global equity markets? Well, I mean, the S&P 500 is certainly not macro consistent in terms of global equities, right? You can see that US stocks represent about 56% of global stocks. International developed stocks, which is mostly Europe, Japan, along with Australia, Canada, a few others, represent 34%, and emerging stocks represent 10%. This is by stock market capitalization. And in fact, if we examine the proportion of economic output, well, the US actually represents an even smaller portion. Only 28% of total world GDP is derived from the United States. The rest of the world, outside of Europe and Japan and China, represents about 40%. China is the next largest contributor at 13%. So, I mean, clearly from a market cap standpoint, we're not nearly getting or capturing the entire global equity opportunity set. And from a GDP standpoint, US markets alone capture an even smaller sliver of the total pie. And if we examine the sector composition of US markets relative to global market cap, we see a larger deviation in US sector bets. Now financials are much more substantially underweighted in US. Technology is a massive overweight, 36.5% overweighted relative to the rest of the world. The US has a huge underweight in basic materials over toward the far right. Now, you might be looking at this chart and saying, well, actually, these sector bets are reasonably aligned with my views. I would prefer to have a portfolio that is relatively underweight financials and overweight technology and underweight basic materials. And that's totally fine. That expresses your preferences, but that's not the point. The point of passive investing is to have no active views about what the better securities or better sectors are that you want to own. So this is just, the US equity market is just not broadly consistent with a passive view on global equities. They represent very large active bets. And this is important because while US stocks represent only about 50% of global market cap, this means that US investors are often missing out on some huge opportunities outside their borders. And keep in mind, US market cap is 56% of global GDP. Canadian market cap is 3.3% of global GDP. So Canadians are missing out on almost 10 times more of the global opportunity relative to American investors. And this can have a very substantial impact. Check out the rolling 5-year total return differential between international developed markets versus US markets, that's the light blue line, and emerging stocks versus US stocks, that's the dark blue line. And you can see that there are 5-year periods, for example, where emerging stocks outperform US stocks by 300% cumulatively. And that the same goes for international developed stocks that can outperform US stocks by over 300% cumulatively over a given 5-year period. So it is important to recognize that you are giving up on these pretty substantial opportunities. And again, this is even more profound for Canadian investors.